Do you know where money comes from? Or how it's created? Most people, when they think about the creation of money, they imagine the government using some giant printing machine that churns out thick rolls of dollar bills. But that's simply not the case. The creation of money is far more complex and fascinating. In this video, we will explore the world of banking to unravel this mystery of money creation. Money and banking, two terms that seem rather straightforward, actually hold a lot of secrets. Banks, you see, are far more than just vaults that hold our money for safekeeping. They play a vital role in our economy, acting as intermediaries or middlemen between savers and borrowers, and facilitating transactions. But here's where things get interesting. Banks are also key players in the creation of money. Yes, you heard that right. Every loan a bank gives, every mortgage it approves, and every deposit it receives is creating new money. This is due to a system known as fractional reserve banking, a concept that might sound intimidating and confusing, but it is the very heart of our financial system. So now you know that money comes from fractional reserve banking, but how exactly does it create money out of nothing? In our world today, when you deposit $100 into a bank, the bank doesn't just store all your money in a safe. Instead, it keeps a fraction of it, say 10%, as reserves, and lends out the rest. This is the essence of fractional reserve banking. So what does this mean for money creation? Let's go back to the example. You've deposited $100 into the bank. The bank keeps $10 and lends out $90 to someone else. The person who borrows this $90 might use it to pay for a good or a service like a haircut. Now the person who got paid to cut their hair then deposits that $90 into their bank. This bank, again, keeps a fraction as reserve and lends out the rest. The cycle continues, and with every loop, new money is effectively created in the economy. You see, the original $100 you deposited has now turned into $190 circulating in the economy. You might be scratching your head, wondering, wait a minute, how does this create money? All the bank is doing is moving funds from one person to another. Well, here's the catch. Every time the bank loans out money and it gets redeposited, the total amount of money in the system increases. This is because the original $100 you deposited is still in your account, and the money that was loaned out and redeposited is also in the system. So, the bank has effectively created $90 of new money. You might be wondering how the original $100 is still in your account, even after the bank lends $90 to someone else. This is because this money is nothing but a digital number. Most of the money in our system today isn't physical cash. Think about how often you pay for goods or services with an electronic funds transfer. Electronic funds transfers are credit cards, debit cards, gift cards, and any sort of mobile device payment app. Hardly ever do we use cash for purchases, especially ones with significant value. That is why it is so easy for the banks to lend out money, because if a man needs a loan for a house, the banks can transfer that money electronically to show the specific loan amount digitally in the man's bank account. They didn't give him real money, but rather purchasing power. Now the bank will also create money from this scenario because the man will have to pay the bank in which he most likely already holds his money in, which means the bank is already using his money. Then he would have to pay interest for the loan, so the bank will get the man's money as well as their money back, then loan all of it back out to someone else and create more money. The total amount of money that can be created from your original deposit depends on the reserve requirement. The lower the reserve requirement, the more money can be created. Now you might be wondering, does this mean banks can create an unlimited amount of money? Well, not quite. While banks can create money through lending, they're constrained by the amount of deposits they receive and the reserve requirements set by the central bank. Now that we understand the fractional reserve banking system, let's go over the risks involved. This system is anything but a walk in the park. It carries with it a hefty weight of risks. Comprehending these dangers is essential. The first risk we'll discuss is the risk of bank runs. Imagine this scenario. Rumors of your bank's approaching failure reach your ears. The fear of losing your hard-earned money makes you rush to the bank to withdraw all your money. However, you find yourself amidst a stampede of like-minded people, all driven by the same fear, losing their money. The bank, operating under the system of fractional reserve, doesn't possess enough cash on hand or liquid assets to cover the sudden surge in withdrawals. It's a domino effect. Panic ensues. People want to withdraw their money. The bank is overwhelmed, unable to fulfill the requests of withdrawal demands. This catastrophe, known as a bank run, can trigger the downfall of the bank, leading to serious economic repercussions. We then arrive at the threat of insolvency. Banks distribute a substantial fraction of their deposits as loans, yet what is the consequence if these loans go unpaid? What would happen if a significant proportion of borrowers default? The bank might find itself tangled in a financial deadlock, unable to meet its obligations. This precarious situation, termed insolvency, can lead to the bank's demise, sending shockwaves through the entire financial system, causing a domino effect. Lastly, we must face the reality of financial crises. The fractional reserve banking system is a tangled web of interconnections. Banks lend to one another, businesses and consumers, forming an intricate network of financial relationships. However, this interconnectivity can prove to be a fatal flaw. One bank's failure can disseminate like a disease through the financial system, resulting in a widespread financial meltdown. Yes, there are safety measures to buffer these risks, such as deposit insurance schemes and central banks performing the role of lenders of last resort. But these precautions are not infallible, and the hazards of fractional reserve banking persist. In conclusion, while the fractional reserve banking system presents an intriguing approach to money creation, it is accompanied by grave dangers: bank runs, insolvency, and financial crises. These are the inherent risks of the system. Fractional reserve banking, an intriguing yet potentially perilous phenomenon. Let's wrap up our discussion on fractional reserve banking. This financial system is the backbone of modern economies, a mechanism that might seem magical at first glance. But it's not magic, it's math, and it's not without its risks. It's the process that allows banks to lend more money than they physically have in their vaults. The central idea is that banks only need to hold a fraction of their depositors' money, hence the term fractional reserve. The rest they can loan out, thus effectively creating new money. This money creation process works like a domino effect. When a bank loans money to a customer, that money eventually finds its way back into the banking system, either through the recipient depositing it in their own bank or using it to pay someone who does. This newly deposited money can then be loaned out again, and the cycle continues. But it's not all rainbows and sunshine. There are risks involved. If everyone decided to withdraw their money at once, a bank run could occur, and the bank might not have enough reserves to cover all the withdrawals. This is where the central bank steps in, acting as a lender of last resort to prevent a total collapse. Moreover, if banks lend too recklessly and borrowers default on their loans, this could lead to financial crises. Remember the subprime mortgage crisis of 2008? That was a prime example of the dangers of irresponsible lending. So, while fractional reserve banking is a powerful tool for economic growth, it requires careful management and regulation to prevent abuse and ensure stability. It's like a double-edged sword. It can either stimulate the economy or, if misused, lead to financial disasters. Next time you deposit money in a bank, remember, you're not just saving. You're actively participating in the creation of new money.